Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. Is the era of the Magnificent Seven tech stocks over? The companies that powered a 54% surge on Wall Street over the past couple of years dipped into correction territory last week, led by a major slump in Tesla shares. But all eyes really were on the biggest announcement of the Wall Street reporting season, Nvidia. The chip maker announced sales for the 3 months to the end of January of $39.3 billion, up 78%, but the market reaction wasn't great, with a sell-off following that announcement. So is the golden run for the tech sector over? Or are we just entering a phase with an even smaller number of winners? Remember, this is general information only and you should seek professional advice before making investment decisions. Josh Gilbert is a market analyst at social investment network eToro, and he's with me in the studio. Josh, welcome back to Fear and Greed.
Thanks very much for having me, Sean.
So what do you make of Nvidia's result?
Oh, look, I mean, it was great, but it wasn't quite perfect, right? And I think from when we've come to expect from Nvidia, we kind of need perfect. And I think in terms of when Nvidia reported, it was kind of when we had that dip into correction territory for the Magnificent Seven. So the market was looking towards Nvidia to sort of kind of be that savior. And look, I still think the results were fantastic. Still sort of shows for me that AI demand is still there. Ultimately, I think it put to bed some of those concerns around DeepSeek. It kind of put to bed some of those concerns around AI demand. The sort of what the market is focusing on is the dip in margin guidance for next quarter. Came in a little bit below estimates, but I think it's a bit of an overreaction from the market. The market is sort of dialed in on that margin guidance, but really what they've sort of not looked at is the fact that, okay, they've sort of ramped up Blackwell production at the fastest pace ever. They've just delivered $11 billion in revenue for Blackwell. That sort
Blackwell, of course, being the chip.
Correct. Yep. And ultimately that put to one side that sort of idea that, Blackwell, sort of production was slowing down. So really it's one of those question marks. Okay, there's always something, I think, to sort of pick a weakness in. And if it wasn't going to be sort of a dip in margins, then it would have been the Blackwell production not coming through. So for me, that little bit of lower guidance on margins is needed for this business to keep innovating, to stay at the front of its game, and ultimately keep delivering the supply given the demand that they've got from sort of big tech right now.
You mentioned DeepSeek. Jensen Huang, the CEO, talked about it and actually welcomed DeepSeek, which is kind of what CEOs do, I suppose. Is it a threat or not?
Right now, no. I don't think so. Look, I think if anything, it sort of really adds to this sort of growth that we're seeing in AI. More products is great for AI. We're going to continue to see that coming through. We weren't ever going to continue in this AI phase without seeing sort of new players coming into the game.
Yep.
For me, it may be something in the future that if there are sort of cheaper products that come to market, that can still be at the high quality that Nvidia produce, that's where the worry comes. For now, though, big tech want the best. They're going to Nvidia because they are the best. No one can compete, right? And I think that's the big thing here is that, if you're spending the billions of dollars that big tech are, Microsoft, Amazon, all of them just announced more. I think they're spending between about $400 billion in 2025. That's about $100 billion more than last year. So when they're spending that sort of money, they want the best. And as I say, that's Nvidia right now.
So Nvidia can keep going. It's worth, almost $3 trillion at the moment. Can it keep going?
I think so, yeah. Look, I think this sort of sell-off, will bring opportunities for investors to sort of get in at, better prices. And I think ultimately that view of that, increase in spending again, as I said, $100 billion increase, a lot of that is going to be going straight to Nvidia. The worry, I think, for me is that what we saw this quarter was the 50% of revenue is coming from those hyperscalers. It's coming from those big names. That is a bit of a worry for Wall Street, because if for whatever reason we do see that slight slowdown, if they do pull back on spending, then that's where it's going to hurt Nvidia a little bit. They want to see that sort of broaden out, but I think that will come. And I think that we're starting to see use cases for AI broaden a lot more. And one of the reasons for that margin guidance dropping was that they are rolling out new products. They're bringing new products to market. They're innovating. And that is to sort of really help with this sort of, absolute broad range of options that AI is bringing. That's only going to continue. So I think that we'll start to see that 50% come down a little bit, that reliance on big tech come down, but that will be really important. But for me, sort of this doesn't change anything for me for Nvidia. They're still the best in the game. So yeah.
Okay, let's go to Tesla. Peak to trough, about 35-40% down. Obviously, a lot of focus on Elon Musk and whether or not he's distracted. There was figures out last week about sales out of Europe, strong EV sales, but not strong Tesla sales. I think they were back 45% or thereabouts. What's the outlook for Tesla, and is Elon Musk too distracted?
I think so at the moment. Yeah. I mean, look, look, if anyone follows him on X, then you'll see how distracted he
You
is.
can't not follow him on X, because if you open X, you always get Elon Musk, whether you like him or not.
I actually sometimes wonder what he does other than actually just send tweets. But no, I think, look, the biggest thing here is that our view on Tesla is that we're sort of changing it slightly from being an EV name to being more of a technology company. I think really EV is it's bread and butter. Yep. But for the time being, we are sort of starting to see those sales slow down a little bit, which is a bit of a worry to the market, absolutely. But I think as time goes on, we'll see this move more into sort of an AI and autonomous robotics play as time goes on, with sort of, Tesla still at the forefront of, the EVs being part of that. But we are seeing demand slow a little bit. I think if we do start to see rates come down in the US, that should sort of help things a little bit more over, the next couple of months towards the back end of the year, because ultimately owning a Tesla is still a luxury product right now. Mm-hmm. So until that sort of new model comes online, that sort of cheaper, lower range model, talking I think between sort of $30,000 US, that will be a bit of a boost, because right now they are sort of being outpriced by the likes of BYD. Seeing a lot more of them here, especially on the road here in Sydney, cheaper products. I think that's sort of really driving sales at the moment.
We'll take a quick break, Josh. We'll be back in a minute and look at the broader outlook for the Magnificent Seven. I'm speaking to Josh Gilbert from eToro. So, Meta Platforms, owner of Facebook. Who would have thought, the old man of tech stocks, it's kind of the outperformer at the moment. Yeah. Why?
Look, I think in terms of what it's doing revenue-wise from advertising, brilliant. And it's really sort of narrowed in on video advertising. That's done really well. I actually saw a piece yesterday saying that from Instagram, which is, a company that Meta owns, they're looking to maybe even spin off Reels, which is sort of one of their big video platforms, into a separate app. So it just shows the success that they're having there. And I think a lot of that comes from comparison to YouTube, right, which is obviously owned by Alphabet. It's actually, YouTube is the second biggest search engine in the world, behind Google, both owned by Alphabet, obviously, which is a bit of a monopoly, as we know. But I think Meta is doing very well to sort of compete in that sense. They're sort of driving, social media engagement through that platform, through advertising. I don't think they have a lot of concerns, really, if we look at maybe some of the other big tech names. I think we look at, Microsoft, Amazon, Alphabet, their concerns are sort of coming from this slowing cloud growth a little bit. Yeah. Meta is just sort of delivering on, I think in a lot of places, they've sort of put behind that Reality Labs, those losses, that sort of really sort of, market isn't worrying about that anymore. It's kind of in the background, not really too much of a worry. It's really been driven by that advertising growth, which I think is very strong, and I think it will continue to be as well.
Okay, so let's go on to Alphabet then. What is it about Alphabet that people are wary of?
It is that cloud growth, right? That's their key driver. That's, their margins have been fantastic for that part of the business. It's come from, basically negative margins to being about, I think EBITDA margins are about 70% for Google Cloud right now, which is, huge, really, driving profitability. Again, it's still an advertising powerhouse, still has billions and billions of dollars on the balance sheet, a fantastic business. But the problem here with those names and something like Alphabet, cloud growth was slowing, but it comes back to Nvidia again, because it comes back to demand. Demand continues to sort of outstrip supply. Alphabet really don't have the supply to be able to fulfill the demand that they're getting. So that's why we're sort of seeing that slower growth. So from our perspective, it's not a huge worry right now. It's if they get that supply and then the demand doesn't come through, that's when I'd be more worried.
Okay, so we have a couple of minutes left, but let's run through kind of, in a sense, the ones that many of us have known for many years. Microsoft, obviously, Apple and Amazon. Yeah. What's the prognosis for those three?
So Microsoft and Amazon, absolutely same issue here as Alphabet, Google. Yep. It's that cloud growth. Again, both names sort of really pointing towards supply not being there. Again, that's probably Nvidia's fault right now. That's that. Microsoft is still sort of seeing strong growth across other areas of the business. Amazon, strong sales in Q4. We always see that around that sort of period of the year. Growing advertising revenues as well. But really, again, the money makers for these businesses are cloud. It's AI. That's what's making them the money. So if we're not seeing that growth that the market expects, we're going to see a bit of weakness, because the reason that we're seeing markets sell off a little bit at the moment, NASDAQ year to date is actually negative. Mm-hmm. The reason we're seeing that is because there was such a big anticipation for AI coming up, and we just probably didn't get exactly what the market expected. Apple, on the other hand, is a name that I think really does intrigue me. I just think it's I think we're in the studio now, and we've probably all got iPhones, right? Everywhere, it has one of the largest installed bases across the world, billions and billions of users. Its services platform, which is an integral part of the iPhone, iPad, Mac, is growing at a rapid rate. Huge margin business. I think that's fantastic. I just think the weakness is a little bit overdone. I think we're seeing Tim Cook get a little bit friendlier with Donald Trump as well, which I think is good news for Apple. The China tariffs do continue to be a bit of an overhang, but I think this is a stock that's not going to be sort of beaten down forever. It's not a shiny apple right now, but I think if you polish it up over the next year, I think come sort of start of 2026, we'll see it in a much better position.
So talking about Shine, the final question, is it kind of the peak run for the Magnificent Seven over, with the background of tariffs, of Trump certainly putting money into steel and manufacturing plants in the US and stuff like that? So everything's relative, of course. Is the golden run of tech stocks still going to keep going? I mean, it's been going for a few years now. Can it keep going?
I don't think we're going to have the golden eras that we've had.
Right.
So the last couple of years, if we think about the S&P 500, plus 20% gains in the last 2 years, that's very rarely happened. I'm not sure if it has happened many times before. So if we look at that and sort of say, okay, can that continue into this year? We would need, very, very high, revenue growth, earnings growth. And I think at market expectations, we're probably not getting what the market wants from tech right now, given how far we've run, given where the valuations are for a lot of these tech companies. If you're paying for perfection, you want perfection. We're probably not getting that right now. So I still think they'll perform very, very well. I just don't think that they'll probably lead the market within the last year as they sort of have done. I think if we look at earnings growth in the quarter, 17%, still pretty solid for the S&P 500. So we're pretty positive on that. But ultimately, the Magnificent Seven will need to keep delivering on AI, and I think again, Nvidia is the key driver of that. Yep. If they can deliver that supply to those big tech names, then we'll see that cloud growth increase, and then that will sort of drive revenues, drive earnings, and drive share prices.
Fantastic. Josh, thank you for talking to Fear and Greed.
My pleasure, Sean.
That was Josh Gilbert, market analyst at social investment network eToro. This is the Fear and Greed business interview. Remember, this is general information, and you should always seek professional advice before making any investment decisions. Join us every morning for the full episode of Fear and Greed, daily business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.